Hello and welcome back to Core Finance with me, Matt Brown, coming to you live from London. And it gives me great pleasure to welcome back onto the show Alex Zambrano, who is the Chief Market Analyst at Amana Capital. How are you today, Alex?
Very good, thank you.
Good, good. Well, the market's we're seeing a little bit of volatility, but also volumes are as to be expected.
Yeah.
The summer months are a little bit quieter. Now, you've come on today to talk all things dollar.
Yes.
We've got a few slides to look at to explain recent dollar moves and potentially where the dollar could go from here. Now, starting off, we've got a current implied probability graph. Now, this, I believe, is the probability of a Fed quarter point rate hike in December.
That's
this
correct.
year. So just talk us through this chart and where we're at the moment.
Yeah. So right now, this chart is at 30.2, which means that there's a 30.2% likelihood of a rate hike by the Fed in December. Now, why I'm highlighting this is because one of Fed's plan for this year has been to increase interest rates 3 times. They've done 2 rate hikes already. Now, as you know, most of the data from the U.S. over the last few months has been bad. Inflation is not really around 2% any longer. And these are factors that has lowered the likelihood of the Fed actually increasing interest rates.
And we can see that on the graph. It's
clearly can see that
dropping off there.
Yeah, at one point earlier this year, the market was giving it a 60% likelihood of a rate hike. And if we just look at the charts, we're pretty much at the lows we've seen in 2017. So the idea is, but the Fed themselves, of course, they're still believing in the idea of a Fed rate hike. So from this perspective, if we look at the chart, the idea is that the expectations right now for Fed rate hike are really low. And I would argue that maybe from these levels, we maybe found some sort of a low here, and that the expectations could increase going forward. Now, why is this relevant? Well, it's relevant because if people suddenly start to price in a rate hike again, we might see the dollar gain, and more importantly, maybe just see the dollar decline we've seen recently slow down and again potentially reverse.
Moving on to the next chart, just explain. You've already mentioned the economic data coming out of the US. Just explain this chart to our viewers and how this works.
So this is City Economic Surprise Index, and we have data from 2008 until present time. And the way it works is that when this indicator is above 50 and close to the highs, that's when data has been beating expectations. Whereas when the indicator declines and goes below the 0 line, that is when data is failing to meet the market's expectations. And a lot of people, well, actually, I think everybody knows, I guess I said in the beginning here, that the US data has not been good. But with the NFP on Friday, good NFPs at the last reading, we can now see how this indicator is starting to bottom out. And it does suggest really that maybe US economic data can impress the market going forward. And why is it like this? Well, I think it has to do with the fact how the industry works. Because as an economist, many times, you might have your estimations where the data should be at, but you don't want to deviate too much from the herd. So in these series, people herd. So for example, you have a very good reading for US economic GDP, but you see that everybody else has low estimations. So what you'll do, you'll lower your estimation as well to not deviate too much. Because obviously, if you get it right, you'll be the star.
Yes.
But if you get it wrong, you might lose your job.
Yeah. Like a fund manager, say, tracking against an indice, you don't want to be too far out there because if you get it wrong,
exactly.
So it's that herd mentality. So you see that as well in economics or economists.
And economic forecasts, right? So obviously, because the US data, I think, has been bad for such a long period of time, people are now lowering and lowering their estimations. And now suddenly, the data starts to beat again, and then it goes the other way around.
Yes.
So again, looking at this data or this time series, which is, it's not a trending, it's something that doesn't trend, it's actually something that trades sideways. It does suggest really that most likely in the next few months, US data is going to beat expectations. And that obviously is interesting if we look at how the market is set up for a rate hike by December.
Indeed. So potentially dollar positive.
Dollar positive, yes.
Moving on to the final slide. This is the dollar index, and going back over 5 years on this, and as viewers will clearly see and will know the dollar's been out of favour this year, and it has sold off quite aggressively. So just talk us through this chart and where we're at now and where we could potentially go for the dollar index.
So technically, of course, we're just above major support. We're just above the 2016 lows and some of the lows we've seen as well in 2015. Everybody loves to hate the dollar right now. And again, we probably need to see that better data. Probably need to see inflation tick up a bit. Probably need to see the situation between North Korea and the US cool off a little bit. But technically here, given all these different factors we discussed in the first two slides, it does look to me that we shouldn't be too bearish or be selling the dollar at current levels. It's okay to do that in specific currency pairs and things like that. But if we look at this from a purely technical point of view and all the other data, it does suggest to me that the dollar decline should slow down. And in certain currency pairs, we might even see some dollar strength.
So I mean, a lot of this as well is on the back of euro strength. You know, the euro makes up, I think, about 50% of the dollar basket, the dollar index. So
that's correct.
Would you say this is caused by euro strength or dollar weakness, or a combination of the two?
I think that's a good point, actually. I think it's probably due to the situation in the Eurozone as well, of course. I mean, I think was it this time last year, everybody said, well, sell European stocks and buy US stocks. And then finally they realized that, hey, maybe European stocks are quite undervalued. And then we saw all these PMIs heading up higher for the Eurozone and doing quite strongly because obviously after many years of very low consumption, suddenly, you know, you have a little bit more money. You need to get a new kitchen installed, a new car, maybe an extension to the house and things like that. So things are obviously looking good in Europe, and suddenly people are noticing that. They're taking positions in the euro, and also, of course, on anticipation that the central bank is going to change its outlook. Now, that's interesting because everybody got super excited about inflation. And I was reading, because I have, you know, on Twitter you can follow people from different parts of the world, right? So there's some guys, like in Germany, that's been very vocal, like, oh, inflation is so high in Germany. And it's the same people that said when we're heading into deflation, they were like extremely worried. But now we've seen an inflation taper off a little bit in the Eurozone. Why? Because the strong rise in inflation is primarily due to crude oil prices. And all of this points to me, at least, that we shouldn't be too optimistic about what the ECB is going to do in the next 6 months to 1 year.
Understood.
Because I do think inflation can pull back. As an example, core inflation is around 1%, right? So if indeed pulls back, the expectations of, you know, major adjustment by the ECB should, you know, ease.
So in the meantime, dollar, are you positive on the dollar, and do you think we'll see an interest rate hike in December?
I think, yes. I think there's still quite a good amount of time for the US data to recuperate. So yeah, I do think we can push for a rate hike. And there's certain currency pairs where you can be bullish the dollar. As an example, I have some short-term positions in the Aussie dollar versus the USD. So I'm short Aussie dollar, New Zealand dollar, NCD USD, and also, you know, some positions as well in, say, dollar CAD. However, on the euro, I'm actually quite a little bit positive, and in the pound dollar, I'm neutral, and in the dollar yen, I'm actually selling the dollar and buying the yen.
Okay.
So we need to take all currency pairs and treat them independently, I think.
On that note, Alex, thank you very much for joining us today.
Thanks so much for having me.